Yeah, so under conversion of a partnership into a company, so under conversion, we said in this case, the key accounts you'll end up having to prepare. We have in this case the business purchase account, business purchase account. Then you might be called upon also to prepare what we call a realization account. Then there is the partners account. Partners account. There is the partners account. Then sometimes there's what we call the vendors account. Vendors account. This one sometimes we call it the purchasing company account. Purchasing company account. So with this one, we said you likely debit all the liabilities which have actually been taken up. So all liabilities taken up will be debited. All liabilities which have actually been taken up, liabilities taken up by the newly formed company, then you'll credit the assets which have actually been taken up, taken up by the newly formed company. Then also you can be able to credit goodwill on conversion. You can be able to credit goodwill on conversion. So the balancing figure in this case is the purchase consideration. The purchase consideration. The balancing figure will likely be the purchase consideration. Then we have this one. You might actually also in this case be called upon to prepare it. It is known as the realization account. So with this one, you'll debit all the assets which have actually been taken up, all assets taken up. Then you'll credit the current liabilities taken up, liabilities taken up. Then in any case, there was a partner who took an asset. That asset never went to the newly formed company. So you can also, in this case, also credit assets taken up by partners. Assets taken up by partners. Assets which have actually been taken up by partners. Then also you credit in this case the purchase consideration you'll have here. You'll credit the purchase consideration. You'll credit the purchase consideration. So these assets, they're supposed to be at net book value. So it's supposed to be at net book value. The assets taken over, the assets taken up, the assets taken up, not taken up, but taken over. The assets taken over, the assets which have actually been taken over. So these assets here, these ones are supposed to be at net book value. So these ones are at net book value. They are the assets which have actually been taken up at net book value. Then you credit the current liabilities taken up. Then credit any assets taken up by the partners. Then you credit the purchase consideration. The balancing figure in this case, can actually end up having to be the realization gain, what they gained, realization gain, or in this case, it can be a loss. It can be a realization gain, or it can be a loss. So that is in this case what will likely be contained in this account if you are called upon to prepare. Then the partners account is the usual one, you know. So all the benefits of the partners will likely end up having to be on the credit side. In any case, they drew any amount from the partnership, you likely end up having to debit. You'll debit. So you'll likely be given the balance carried down of the balance brought down of the partners account. Then they can give you the current account balances. They can give you profits which were taken over. There's this goodwill that, for example, in this case was in the business purchase accounts. This goodwill here, they'll end up having to share. They'll share that goodwill. So they'll share that goodwill. So that goodwill will likely be on the credit side. So anything that is of the benefit to the partners will likely be credited in the partner's account. If they're having any form of drawings, you likely end up having to draw from the partner's account. So what will be the balancing figure? In most of the instances, you'll be told that balancing figure is what they actually eventually converted into share capital in the newly formed company. So because now in this case in our company, we don't have the form of capital that we have in our company is not like the capital we have in this case in our partnership. So the balancing figure, which is normally on the debit side, you'll be told that they converted it into shares. They converted it into shares. So that is what will happen. That is what will happen. That is what will happen. So that is it. Those are the accounts that in this case major will likely be called upon to prepare. So hope you've been able to open that question. Hope you've been able to open that question because I want to start looking at it. I want to start looking at it. I can see Duncan says the board is not clear. What about the others? I can see Duncan is saying that the board is not clear. What about the rest? What about the rest? What about the rest? So hope you open that question, December 2023, question number 3. So it says, R&M were partners in the business of buying and selling fruits for 2 activities, export and oil processing, sharing profits and losses in the ratio of 2:1 for R and M respectively. The partners agreed that with the effect from 1st of October 2023, the business will be split off and be transferred to 2 separate companies, P Limited and Q Limited. P Limited took over the fruit buying for export business, while Q Limited took over the fruit buying for oil processing business. The partnership statement of financial position as of 30th of September 2023 was as follows. So you've actually been given the non-current assets. You've been given the current assets for the export and oil. Then in this case, you've actually been given the total assets. You've actually been given the total assets there. You've been given the capital accounts for R&M and the current account balances for R&M. Then there's the non-current liability, which is a loan. There's the current liability, which is a bank overdraft. There's trade payables, which is for export and oil. Then you have the total capital and liabilities. Then you've been given a number of additional information there. Then you're actually called upon to prepare the business purchase account, then the partner's capital account, then the bank account, then the vendor's account. Then eventually you come up with a statement of financial position for P Limited and Q Limited after the conversion. So P Limited is now the newly formed company from the partnership, and Q Limited also. So they want, in this case, you come up with a statement of what? Of financial position, statement of financial position. So, so the first account in this case they want us to prepare is the business purchase account. The business purchase account. So they want us to prepare the business purchase account. So business purchase account. They want us to prepare the business purchase account. So so our shillings are in thousands. Our shillings are in thousands. Shillings of thousands. So shillings of thousands. So additional information number 1. P Limited took over all the non-current assets. All the non-current assets, cash, bank overdraft, and its share of what? Trade receivables, inventory and trade payables. Q Limited took its share of the trade receivables, inventory and trade payables. The assets and liabilities were transferred at book values, and the partners were paid 300 million, being goodwill for the oil business, and 240 million being goodwill for the export business, for the export business. So we've been able to say in the business purchase account, you end up having to credit all the assets which were actually taken over, all the assets which are actually taken over. And of course, there are two companies here. So of course, there are two companies here. There are two companies here. So we have in this case P Limited and of course Q Limited. You have P Limited and of course Q Limited. So you'll end up having to have two columns there. So there are two companies there. So P Limited, then Q Limited, P Limited and Q Limited. So for the assets taken over, we're having to say you'll end up having to credit. And you've been told P Limited took over all what the non-current assets, which in this case is land and buildings, motor vehicle, equipment, and investment property. So land and buildings. So you credit all the assets taken over, land and buildings, motor vehicle. We have motor vehicle. Then we have in this case equipment. We have in this case equipment and investment property. Equipment and investment property. Equipment. Then investment property. So all these ones were taken by P Limited. So we credit all the assets which are taken over. So the amounts were 750, 390. So 750,000, 300,000, 90,000, and of course 9,000. So that is the first thing you're having to be told they took over. Then they also took over cash and bank overdraft. So cash, the cash in hand is actually how much? 3 million. So they took over cash, which is actually 3 million. And of course, also what? The bank overdraft. So the bank overdraft is a liability. So liability is taken over, you debit them. So bank overdraft, they took over the bank overdraft, which is 537,000. So 537,000. Then also their share of trade receivables, inventory, and trade payables. So trade receivables and inventory are assets. So trade receivables, these are assets which are taken over, and inventory. Trade payables is a liability. So liability is taken over, they come this size. Trade payables. So for the trade receivables, you need to, they were taking what? The export business, They were taking the export business. So for the trade receivables, they took, in this case, 384,000. To inventory, 1380. So 384,000 and 1380. 384,000 and 1380,000. Then for trade payables, they took over for their export was 537 or 924. Is it 924? 924,000. 924. They took over 924,000. Then Q Limited took its share of trade receivables, inventory, and trade payables. So Q Limited, they took over their share of what? Trade receivables. For them, they were taking the oil business. So this one was 648,000. 648,000. And this one was 675. This one was 675,000. For inventory, they took over 675,000, which was for the oil. And for trade payables, it was 56,000. Is it 156 or 56,000? Is it 156 or 56,000? It is 56,000. So they took over 56,000. 56,000, 56,000, 56,000. So 56,000, 56,000. So they took over 56,000 of the trade payables, trade payables. So because for them, they were taking what? The oil business. They were taking over the oil business. They were taking over the oil business. Is it 156 or 56? So let me confirm. Seems what I have here, that figure is not correct. Is it 156 or 56? It is 56, eh? Yeah, so they took over 56,000. 56,000. They took over 56,000. 56,000. 56,000. Yeah, so then in this case, we can continue. You are told the assets and liabilities were transferred at book values, and the partners were paid 300 million being goodwill for the oil business, and 400, in this case, 240 million being goodwill for the export business. So in this case, the goodwill on conversion, you also in this case end up having to credit it. Goodwill on conversion. So we say goodwill on conversion. The goodwill on conversion. In this case, it is for the oil business, and of course for the export, we have in this case 300 and 240. So 300,000, then 240,000, 240,000, 240,000. Then you are told the bank that had provided the loan agreed to accept 43.2 million, 10% debentures in P, and 28.8 million, 10% debentures in Q. So in short, what was happening, so they took over this liability of the bank loan. So there's a bank loan there, which is 72 million. So when they were converting, these companies took over, but now they've converted it into what? Into a debenture. So loan that was actually converted into debentures. So loan to debentures, which was taken over. The loan was taken over, which is a liability taken over. Loan to debentures, which they took over. They took it over, but of course they converted it into what? A debenture. So therefore, in this case, for they agreed 43.2 million in P Limited and 28.8 million in Q Limited. So 43,200 and 28,800. 28,800. 28,800. So 28,800 and 28,800. 28,800. So that is what in this case they ended up having to do what? To agree. So that is what they actually agreed. That is what in this case they actually agreed on. So I think those are the only ones. Those are the only ones. So maybe you can be able to get the totals here. So try to get the totals here. Get the totals here. You can get the totals there. You can get the totals here. The totals there. The totals there. So because the next point they're having to say the purchase consideration was settled by the allotment of fully paid ordinary shares of 20 each in the respective companies as follows. In the respective companies as follows. In the respective companies as follows. So the purchase consideration which we are going to get here, the purchase, what they were supposed to have been paid. The purchase consideration. This is the difference between the assets being taken over and of course the liabilities that were having to be taken over. When you weigh them, you should be able to see how much are they supposed to be paid over and above. After canceling out the liabilities with the assets, over and above, how much should they end up having to be paid by the two companies? So what is the total here? Goodwill. So what is the problem with goodwill? So the assets and liabilities were transferred at book values and the partners were paid 300 million 300 million, as in this case, what? Goodwill, being goodwill for the oil business, and 240 million being goodwill for the export business, being goodwill for the export business, being goodwill for the export business. Or it's supposed to be the other way around. It's supposed to be the other way around, eh? So the export, we have in this case for the export business, so being goodwill for the export business. And in this case, this one being for the oil business. It's supposed to be the other way around. Eh? So this one is supposed to be 300. 300, 300, 300. It's supposed to be 300. Eh? So you can be able to add now. So because in this case, the oil business was actually having to go to Q Limited. So it was going to Q Limited and the export was going to P Limited. I think it's supposed to be the other way around. So you can now add, So you're getting what? 1623. 1623. This one is 1623. What about this one? What about that one? What are you getting? 315. 315. 3153. 31. This one is 3153. Confirm that figure. Confirm that figure. Confirm that figure. 3153. Okay. Can see you're saying 3153. 3153. Can see you're saying 3153. But let me just confirm. Let me confirm also. Is it 3153? 3156, eh? 3156. So 3156. 3156 is coming to 31,56,000. So you can put here 31,56,000, then 16,23,000. Then you get the difference to get the purchase consideration. So what is the difference to get the purchase consideration? What is the difference to get the purchase consideration? So we have in this case 1623 00 minus 28,800 minus 56,000. This we're getting 1538. So 1538 200. I don't know if it is correct. 1538 200. What about here? You can also do that one. So 1538 200. And this other one you're getting, you can do the other one. So 537,000. 537,000 plus 924,000 plus 43,200. You get 1504 200. Then we minus 3156. You get 1651 800. So 1651 800. 1651 800. So you can also confirm. So confirm the figures. Confirm the figures. Confirm the figures. You can confirm the figures. Confirm the figures. Is this one correct? 1538 200. Hope it is correct. 1538 200. So so then in this case you are told on 1st of October 2023 the purchase consideration was settled by allotment of fully paid ordinary shares of 20 each in the respective companies as follows. So we have in this case R taking over 71,250,000 shares. Then the balance in the other company, which is Q. Then M taking over 47,760,000. The balance, which in this case is having to be taken over from P Limited, which is having to be taken over from P Limited, which is having to be taken over from P Limited from P Limited. So we can in this case come up with the partners capital account. So the partners capital account, the partners capital account, partners capital account. So we have two partners, we have two partners. I don't know whether it will fit here, but let's see whether it will be able to fit. I don't know whether it will fit here. So there are two partners here. So you have in this case P and of course M. So you have in this case R and M, sorry, R and M. So R and M, R and M. We have R and M. We have shillings in thousands. So shillings in thousands. We have shillings in thousands. Then we can, in this case, we have the balance brought down for the partners. We have the balance brought down for the partners from the balance sheet, what you've actually been given there. So you have in this case 1,500 and of course 900. So the balance brought down, brought down. We have in this case 1,500 and of course 900,000. So this is 1,500,000 and of course 900,000. Then of course also we have the current account balances. So we'll just put them here. The current account balances, which you've actually been given there, it is actually 78,000 and of course 72,000. So 78,000 and of course 72,000. 78,000 of course 72,000. Then also there's actually goodwill. So the goodwill they ended up having to enjoy. The goodwill they ended up having to enjoy. So in total, the goodwill is actually 540,000. So the total goodwill is actually 540,000. But now they were sharing profits in the ratio. Their ratio was actually in this case 2:1. So for R, the goodwill, which in this case he enjoyed, the goodwill which in this case he ended up having to enjoy, when they were converting the partnership, it will likely be 2/3 multiplied by 540,000. Then for M, it is 1/3 multiplied by 540,000. So of course, in this case for R, you'll get a goodwill that they shared, the goodwill that they shared when they were converting the partnership. It will be 360. It will be 360,000. I think it will be 360,000. 360,000. Then of course for M, it will be 180,000. 180,000. If you do the computation there, according to how they were sharing the profits, so this one comes to 360,000, and this one will come to 180,000. Will come to 180,000. Will come to 180,000. Will come to 180,000. So then in this case, in the next note, which now in this case we are looking at, we are having to be told on 1st of October 2023, the purchase consideration was settled by the allotment of fully paid ordinary shares of 20 each in the respective companies as follows. So, so they ended up having to, in this case, take up some shares. So what they did in this case was their capital. What in this case was their balancing figure in terms of capital here, which is ideally what they were supposed to have actually been settled by having to be paid the purchase consideration. That is what in this case they ended up having to convert into what? Into shares. That is what they actually ended up having to convert into shares. So of course now in this case you have two companies. So we have in this case R. We are told R. So our friend in this case R. This person you are calling R. So he took over 71,250,000 shares. So in this case 71,250. Our figures are actually in thousands. So you don't have to put that 1,000 there. Multiply by 20. So these are the shares that he ended up having to take in what? In P Limited. In P Limited. So he took over these particular shares in P Limited. So if you do the computation there, you realize that in this case, he actually took over 1425,000. So he took over 1425,000. 1425,000. That is in P Limited. So for the ordinary share capital in P Limited, so this guy ended up having to take, these are took over in this case 1425,000. 1425,000. Then of course you're having to be told the balance was actually taken over in the other company, which is actually in this case what? Q, which is actually in this case Q. Then you are told this other person M, in this case you have M. So M in this case took over 47,760,000 shares. So 47, we have 47, 760. 760 we multiply by 20. 47,760 multiply by 20. Multiply by 20. So you'll get 955,200. So 955,200. 955,200. 955,200. So this is the ordinary share capital for P. We have the ordinary share capital in this case for the other one Q. So this M took over 955,200. So 955,200. 955,200. The balance of which now in this case you're having to be told, and the balance of the shares were actually taken over in P, and the balance of the shares were actually taken over in P. Were actually taken over in P. So if you do the total here, you need to do the total here. So what do you end up having to get as the totals there? What do you end up having to get as the totals there? So you have in this case 900 plus 72 plus 180. So 900 plus 72 plus 180. I think you'll be able to get 1152. Should be 1152,000. This one is 1152,000. Then the other one, 1500 plus 780 plus 360. So you should be able to get 1938. 1938,000. So this one is 1152,000. This is 1938,000. 1938,000. So it means the balance of which now in this case will actually go to the other party. Will actually end up having to go to the other party. So you need to get the difference. So 1152,000 minus 955,200. Minus 955,200. So let's do the mathematics there and see what are we getting. So 1152. 1152,000 minus 955,200. You get 196,800. 196,800. You get 196. So this 196,800 will go to M. Then in this case, the other balance is 1938,000. 1938,000. You minus 1425,000. You get 513,000. 513,000. So this one is 513,000. 513,000. So Q ended up having to get the other balance in the other company. In the other company. So that is why in this case you likely end up having to allocate the shares for the two in the two companies. The shares for the two in the two companies. 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 So that's why in this case you likely come up with the partners capital account. Then you have now in this case the bank account. You've been told to prepare the bank account. The bank account. So we can rub where? So we can rub where? I don't know whether you can be able to see here. So you can come up with the bank account here. The bank account. You can come up with the bank account here. Bank account. So this will just be able to indicate all the transactions in form of cash that actually went through the bank. So we have in this case shillings in thousands. And of course, this one, we are told we had a bank overdraft. We had a bank overdraft. So there's a bank overdraft. It means it will have a credit balance. Balance brought down because it was a bank overdraft of 537,000. So there was a bank overdraft. So the money in the bank, they had overdrawn the account by 537,000. Then P Limited also raised 12% debentures of 600 million on 1st of October 2023 and paid off the bank overdraft. So they ended up having to raise what debenture. So there were some debentures, which in this case they raised. It means they got money. So they actually got money. They actually got money. So the bank accounts are supposed to be two. They're supposed to be two columns. You have in this case for P Limited and of course for Q Limited. They're supposed to be two. So you can put the two columns. So we have in this case for P Limited and of course for Q Limited. So P Limited and of course for Q Limited. So we'll have in this case balance brought down. So this bank overdraft was taken over by P. So in this case, it's 537,000. Then in this case, the same time, this P Limited sold some debentures. So they sold some debentures and got 600 million. So that is 600,000. 600,000. They got 600,000 from the sale of debentures, 600, so that they could be able to pay off these 537,000. So they sold off some debentures of 12% debentures of 600 million. So those debentures, when you'll be coming up with the statement of financial position, they'll appear as a liability in P. In P Limited statement of financial position, they'll end up having to appear as a liability. But of course, when they sold them, they got money into the bank. So you debit it because the money was coming into the bank. And paid off the bank overdraft. The expenses incurred in raising the 12% debenture amounted to 21 million. So of course they paid now an expense. So you'll end up having to credit because they incurred that expense. So debenture expenses, we have debenture expenses. Debenture expense of 21 million. So in this case, 21 million. We have a debenture expense of 21. So they paid it out of the bank of 21 million. Then this debenture expense, so something we also in this case have to emphasize on regarding in this case accounting for conversion of a partnership to a company. So those expenses that enable formation of the company, they'll end up having to appear as non-current assets. So when you come up with the statement of financial position, any expenses that are incurred, preliminary expenses incurred for the formation of the company, they'll appear as a non-current asset. So this one that they used to facilitate the sale of the debentures, it will appear as a non-current asset in the statement of financial position of what? Of P Limited. So during conversion of the partnership into a company, any preliminary expenses incurred to facilitate formation of the company, they'll be capitalized. They'll become the non-current assets of what? Of that newly formed company. So when you come up with the statement of financial position, this will appear as a non-current asset. It will appear as a non-current asset. Then we can be able to continue. So P Limited and Q Limited also issued 3 million and 4.5 million fully paid ordinary shares at 20 shillings each respectively to two companies, E Limited and F Limited. So they sold off some shares and of course they got money. They sold off some shares and of course they did what? They got money. So P Limited sold 3 million shares and of course now in this case Q Limited also sold 4.5. So each and every share they were having to sell for 20 shillings. So when you sell shares, you get money. So money came into the bank. So you likely end up having to debit the money received in form of what? Issue of shares. So issue of shares, they got money. Issue of shares, they got money. So they actually sold 3 million in P Limited and 4.5 million in Q Limited. So 3 million times 20, you get 60 million. So it will be 60 million. So 4.5 million times 20, you get 90 million. So in this one, they got 90 million. So when in this case, we'll now be preparing the statement of financial position. This will add to the share capital. It will likely add to the share capital. So apart from the shares which were taken over by the partners, they sold extra shares. And therefore, what they had as capital at the end of the year had increased because after the company was newly formed, they further sold other shares to other parties. That is another company and another company. That is E Limited and F Limited. So issue of shares, so 60 million and of course 90 million. So that was money coming in. But still at the same time, we'll have to credit the ordinary share capital account because it increased what? The capital of the business. Then none of the companies has amortized what? Their goodwill. So there's no, in this case, amortization of goodwill there. Then the formation expenses were paid by the respective companies as follows. P Limited and Q Limited, 39 million and 24 million. In this case, when you pay, money is moving out of the bank. So preliminary expenses on formation, preliminary expenses on formation. So for P Limited, they're having to say in this case, they incurred 39 million and Q Limited 24 million. So 39 million and this one 24 million. So 24 million. Remember, I've been able to say preliminary expenses incurred for the conversion of the partnership, they will appear as an non-current asset. They likely be capitalized. They likely, in this case, be capitalized as part of what? The assets. They likely be capitalized as part of what? The assets. They likely be capitalized as part of the assets. They'll be capitalized as part of the assets. They'll be capitalized as part of the assets. So still, these two will be able to recognize them when we'll be preparing the statement of financial position as part of the assets. They are normally capitalized because they facilitated the formation of the new company, the formation of the new company. And therefore, you can be able to get the balance carried down. You can actually be able to get the balance carried down. So you have balance carried down. So the balance carried down, you can be able to get the balance carried down for the bank. The balance carried down for the bank. So this one is 660,000. That one is 90,000. 660,000. That one is 90,000. So this one is 660,000. This one is 90,000. So 660,000. This one is 90,000. So 90,000 minus 24, you get 66,000. So this Q, the balancing figure is 66,000. Then for the other one, 660 minus 39 minus 21 minus 537, you should be able to get 63,000. Should be able to get 63,000. So of course, now in this case, this balancing figure here will appear as an asset. Will likely appear as a current asset in the statement of financial position for the two companies because money in the bank is a current asset. Money in the bank is a current asset. Money in the bank ends up having to be a current asset. Money in the bank ends up having to be a current asset. Money in the bank will likely end up having to be a current asset. So we can now in this case come up with the next one, which is the vendor's account. We can come up with the vendor's account. Vendor's account. We can draw up the vendor's account. We can come up with the vendor's account. So hope you are through with the bank account. Hope you are through with the bank account. You can come up with the vendor's account. Vendor's account. So vendor's account, I want to place it here. I want to place it here where the bank is. So I want to place it here where the bank is. The vendor's account, sometimes we call it the purchasing company account. The purchasing company account, the purchasing company account, the purchasing company account. So the purchasing company account. So we'll have in this case our shillings are in thousands. Our shillings are actually 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 in thousands. So the purchasing company account. So for P Limited, so in this case for P Limited, you have in this case P Limited. For P Limited, we have 1425 thousand plus 196. So for P Limited, in this case, we have 16. So in this case, it comes to 16. This one is 1621. So it's 1621, 800. 1621, 800. And we have Q Limited. Q Limited. So we do 513. 513,000 plus 955, 200. It comes to 1468. 1468, 200. So 1468, 200. 1468, 200. So in the newly formed company, so these guys, so these R and M, R and M, they are basically in this case going to take over an acquisition of shares worth this amount. From in this case, what they had as capital remaining in the business, they're going to take over shares worth these amounts in the two companies. So P Limited 1621, and of course the other one 1468. Then of course now in this case in the vendor's account, of course the balances now in this case will be closed off in the ordinary share capital account. They'll likely be closed off in the ordinary share capital account. Where in this case for P Limited, we'll have 1621 800, 1621 800, and of course for Q Limited, we'll close off in this case with 1468 200. So these ones basically they likely go directly to the ordinary share capital. So they'll go on the credit side of the ordinary share capital. So we'll close it off to the ordinary share capital account in the newly formed company. In the newly formed company. And therefore you need to do the totals. You need to do the totals there. You can do the totals there. So 1621 1621 800. It comes to 3090. So 3090,000. So 3090,000. So 3090,000. It comes to 3090,000. So 3090,000. It comes to 3090,000. So these ones now will contribute to the ordinary share capital. It will likely be part of the ordinary share capital of the newly formed company. These shares they acquired in the newly formed companies. The shares they acquired in the newly formed companies will now be part of the ordinary share capital, which will be able to add on to the new shares which were issued. That is the ones we've gotten in the bank account, the 60 million and of course the 90 million, to be able to get the total ordinary share capital in the newly formed company, to get the total ordinary share capital in the newly formed company, So after that, now in this case, we can now just directly get to financial position, statement of financial position, the statement of financial position. We have in this case the statement of financial position. So for P Limited and Q Limited, it is for two companies. It is for two companies. You have P Limited and of course Q Limited. So P Limited and in this case Q Limited. So P Limited and of course Q Limited. So you can have in this case shillings in thousands, shillings in thousands, shillings in thousands, and shillings in thousands, shillings in thousands. So you start with the non-current assets, non-current assets. So there are those assets which were taken over by P and those taken over by Q. So you just specifically in this case, just place them the way they were actually taken over, the way they were taken over. For example, in this case, P Limited took over land and buildings, motor vehicle equipment, and investment property. So land and buildings, all the non-current assets went to P. Land and buildings, motor vehicles, equipment, and investment property. So you are told in this case, they took over land, motor vehicles, equipment, and all the non-current assets, they went to this company, P. So we'll place the figures here. So it is 750, 390 to 750,000. So 300,000, 90,000, and of course 9,000. 9,000, so 90,000, and of course 9,000, and of course 9,000. So you can be able to get the total there. You can be able to get the total there. So there were no non-current assets which went to Q Limited. So there's been nothing here. But now in this case, we can now go to the current assets. You can go to the current assets. Current assets. So current assets went to both companies. So we have in this case, before those ones, there is these other assets which I was having to tell you, the ones that in this case are capitalized. So we'll be able to refer to them as what? Intangible assets capitalized. Intangible assets which were capitalized. The ones that in this case facilitated formation of these two companies. So we have in this case, one of the intangible assets you have there is actually goodwill on formation. Goodwill on formation, which was coming to, in this case, 540,000. So in this case, for this company, it was 240,000. For this company, it was 300,000. 300,000. Then you have in this case the formation expenses. Formation expenses. So establishment cost or formation expenses. We have formation expenses. Formation expenses. We have on issue of debentures. Issue of debentures. We have on issue of debentures. So this one for issue of debentures, it was in which company? Oh, it was in P Limited. And of course, they incurred in this case 21 million. So they incurred in this case how much? 21 million. 21 million. They incurred 21 million. Then you have the other formation expenses, the other establishment expenses or formation expense. You have establishment costs. Establishment costs. So it was 39 million for this one. Then for this other one, it was how much? 39 and of course 24 million. 24 million. 24 million, yeah. So we have in this case goodwill. So we have in this case goodwill, which was divided on conversion for the two companies, 240 and 300. Then you have formation expenses on issue of debentures, 21 million. Establishment cost, 39, and of course 24 million. Then we have now we can be able to get the total. You can get the total. Suppose there's a total you're supposed to have already been able to get here. So this is 0, 0, 0, 9, 0, 0, 9. It's supposed to come to 1149. 1149. 1149. This one is 540. Not 540, 324,000. 324,000. This one is 60, so 300,000. This one is 300,000. So it will be able to give you now the total non-current assets. It will actually give you the total non-current assets, the total non-current assets, the total non-current assets. Then now in this case, you can go now to the current assets. You can go to the current assets. For the current assets, they went to both companies. So we have inventory, trade receivables, cash. We have in this case cash, because you have in this case what? Bank. So we can start with cash. Cash only went to one company. It went to, in this case, what? P Limited. It was 3 million. 3 million. Then we have in this case bank. Bank now is the balancing figures you've been able to get in the bank account. You've actually been able to prepare to just bring them here. So I think we have a figure of 66 million, and of course 63. So you have in this case 63 million, because this one is 66 million. 66 million. So hope you are able to see there. I can see it is already full. It is already full there. It is already full there. It is already full. It is already full. So you have cash 3 million, which went to, in this case, P Limited only. So it didn't go to Q Limited. Then you have, in this case, bank. These are the balancing figures in the bank account. We have 63 million and 66 million. So we can continue. So I don't want to write there because it won't fit there. I want to continue here, up here. So hope you are through here. I want to continue up here with the balance sheet. I want to continue up here with the balance sheet. Continue with those current assets. I want to continue up here with the current assets. So we have in this now trade receivables. Trade receivables. We have trade receivables. So for the trade receivables, they went to both companies. So we are told in this case, P Limited took over 384,000, and the other one took over 648,000. So 384,000 and 648,000. So 384,000 and 648,000. So 384,000 and 648,000. Then we have inventory. Inventory, P Limited took over in this case 1380 and 675,000. 1380,000 and 675,000 and 675,000. So 1380,000 and 675,000. So those are the only, in this case, what? Current assets we have. Current assets we have. So you can get the total for the current assets. You place here the figure. You place here the figure. Then you'll be able to get the total assets. You'll be able to get the total assets. You'll be able to get the total assets. You'll get total assets. You get the total assets. You get the figure for the total assets. You'll get the total assets. You'll get the total assets. Get the total assets. Total assets. Then now we can be able to go to the capital and equity and liabilities. We can go to equity and liabilities. Equity and liabilities. Equity and liabilities. We can go to equity and liabilities. So for equity and liabilities, automatically we have ordinary share capital. We have ordinary share capital. For the equity and liabilities, we have ordinary share capital. We have, in this case, ordinary share capital. So the ordinary share capital. Ordinary share capital. So we have for P Limited, and we have in this case for Q. limited, for P limited, and of course for Q limited. So of course in this case for P limited, we're having to say it is 1651, exactly 1651 800. But you have to add in this case 60, which they issued. Then for the other one, in this case, it is 1438 200. 1438 200. But of course, they issued 90,000. We'll have to add 90,000, which this is the newly issued, which is in the bank. Is the newly issued, which is actually in the bank. So 1651 800 plus 60,000. Then you have 1438 200 plus 90,000. So this one will come to 1711 800. 1711 800. And this one will come to 1528. I think 1528. 1528 200. 1528 200. 1528 200. So it will come to 1528 200. 1528 200. So that is the ordinary share capital for the newly formed companies. Then we have non-current liabilities. Non-current liabilities. Non-current liabilities. Non-current liabilities. Non-current liabilities. There is a loan which was actually converted into what? Into debentures. There was a loan which in this case was actually converted into debentures. There is a loan which was actually converted into debentures. So there's that loan of 72 million. So they converted it into debentures. So 43,200 and of course 28,800. So they converted it into a 10% debenture. We have a 10% debenture. Debenture. So we have in this case 43,200. So then in this case, in this other one took over 28,800. So 28,800. Then there was another debenture that was actually issued after the companies were formed by P. It was a 12% debenture. It was a 12% debenture, which is actually in the bank. It was 600,000. It was actually in this case 600,000. 600,000. It was not in this other company. It was not in this other company. So there was that 12% debenture, which P issued after they were formed as a company. After they had already been able to convert to now a company which was operating, they issued other debentures. They issued other debentures. So those are the only non-current liabilities. Then now in this case, you have the current liabilities. You have the current liabilities. We have in this case the current liabilities. We have trade payables, which were taken over. Trade payables taken over. Trade payables, which were taken over. So in this case, for P Limited, they took over trade payables of 924,000 and the other one 156,000. So 924,000 and 156,000. So 924,000. So 924,000. So you can just be able to put it here. So this one you're supposed to add, it will be 643. 200. 643, 200. This one is the only one. This one is the only one. It is 28,800. So then the trade payables, you just place the figure here in the final column, which is 924,000. 924,000. Then for this other one, it is 156,000. 156,000. Then you can be able to get the totals. 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 Get the totals. So the figures should be able to tally. They should actually be able to tally. They should actually be able to tally. You can get the totals. Get the totals for the assets and this other side. The assets and this other side. Then you confirm whether they're having to tally. You add the two and then in this case confirm whether they're having to tally. So trade payables is how much? 156 or 56,000? 56,000. It is 56,000. So you're saying 56,000. This one is 56. So 56, so confirm, confirm, confirm. Now you can be able to confirm. Then we can have a break of 5 minutes. Then after that, I think we'll be able to look at another question for still partnership. We want to look at another question still for partnership. So a break of 5 minutes, then we can look at another question for partnership. Yes, so you can confirm. Are they balancing? So you need to confirm whether they are balancing, whether they are balancing. So what are you getting here as the total? Give me the figure for the total here. For P limited, you're getting the total here, how much? For P limited, give me the totals. The total you're getting here and here. The total here for P limited, 3279,000. 3279,000. Is it the same as the other side? Is it the same here? Next, is it the same? 3279,000. What about this side? For Q limited here? Q limited, what are you getting? Here, for the assets, total assets. I adjust the camera. 1713,000. So 1713,000. So this is the very, very last figure. So I don't see the need to adjust. This is the last figure, then the total. We put an equal sign here. So 1713,000. What about the totals for, there's no any other figure here. 56,000 is the last figure. Just give me the figure you're getting there. When you add 1528,200 plus 28,800 plus 56, what do you get? Give me the figure, give me the figure, give me the figure you're getting. You're getting 1613, 1613, 1613. So it is not balancing. So 1613,000, 1613,000. So I think if you look at the, I know where the error is. I know where the error is, and I think that is the reason I was having to tell you this one is supposed to be 156. Then I also asked, is it 56 or 156? If you look at the question, look at the question paper, look at the question paper, look at the question paper. If you look at the question paper, the total assets figure is 4239. That is what you are seeing in the question paper. It is 4239. That is the figure for the total assets. You can be able to see that. Are you able to see that? Are you able to see that? Are you able to see that? It is 4239. Yes. Then add the side of capital and liabilities in the question. Add the side of capital and liabilities and you tell me what you're having to get. Add the side of capital and liabilities and tell me what you're having to get. In the question paper, if you add the side of capital and liabilities, what do you get? So of course, in the side of the assets, you're getting 4239. So that is the figure you've actually been able to get there. Then when you add the side of capital and liabilities, just give me the figure. It is 4139. Another person can be able to confirm. Another person can be able to confirm. Another person can be able to confirm. I can see Omondi is asking a question there. So you can actually be able to, first of all, confirm the figure for, I'll answer you, Omondi, but confirm that figure for the capital and liabilities in the question. 4239. Is it 4239? In the question, not in the capital and liabilities side. Nekesa, have you really added? Have you really added? So you need to confirm. It is 2.4 million plus 150 plus 72 plus 1617. So let me try to add. So 2.4 million plus 150,000 plus 72,000 plus 1617,000. It is 4239. 4239. But now add there is that place of trade payables, exports, there's bank overdrafts, then there is a export, and then of course oil. There's that place for the current liabilities. It is 537,000 plus 924,000 plus 56,000. So if you add, you get 1517. You can see the last figure there for the total current liabilities. You're having to be told is 1617,000. But ideally, when you add individually, 537, 924, and 56, you get, in this case, how much? 1517. You get 1517,000. So there's a difference of 100 there. So in the question, there was a mistake. So that figure for the trade payables is supposed to be 156. Sour. So you've seen why in this case it is not balancing. That is the reason. That's why in this case, initially I was having to tell you the trade payables, is it 56 or 156? So I think I had actually forgotten in the question, there's that mistake there. There's that mistake there of that figure for trade payables in the equation should be 156. So that when you add 537, 924 plus 56, you get 1617. Because if you take that 56 and you place it here, you can be able to see there's a difference of 100. So still take note also in this case, in the business purchase account, you need to correct that figure for trade payables on the business purchase account. If you look at your business purchase account, there's that place I indicated 156, then you told me no, 56. So now you've seen where there was an error in the question. The figure for the trade payables in the question should actually be 156. So you go in this case to the business purchase account. There's that place on the debit side, we've actually been able to put the trade payables where we've been able to say 924,000, then we've said 56,000. We add a 1 here, add a 1 there. Then of course it means your balancing figure here will change. On that side, the purchase consideration you need to also change. Purchase consideration, you need also to change that figure. So this one is correct, but this one will change by a difference of 100. It will change by a difference of 100. So maybe you can be able to give me now the correct figure for the business purchase here. So you change this one to 156, because that is now the correct figure for the trade payables. Then in the business purchase account, it will affect this figure with the balancing figure for the business purchase, the purchase consideration. What is the figure there? It comes to 1438,200. So kindly correct. So 1438,200. 1438,200. So that is the correct figure. And of course, those are the figures we are seeing here. Here, so they are the correct ones. So that's why initially I was having to ask you, is it 156 or 56? So, but now when you look at the question, it is showing that there was an error. I think it was a typing error. It was just a typing error. It was just a typing error. It was just a typing error. So, Omondi, you mean you haven't seen the problem in the question? Do you have the question paper? There's that figure you have been insisting to give me as 56. I hope the rest of you have been able to see where the mistake is in the question. The figure for trade payables, it is supposed to be 156. Look at the question paper keenly, Omondi. You see the figure for the trade payables. You see the figure for the trade payables. Add that place. Add 537, add 924, then add that 56. Do you get 1617? You don't get 1617. You get 1517. So it means the figure for the trade payables is supposed to be 156. It's supposed to be 156. Hope you've been able to see where the mistake is in the question. Then you change the purchase consideration here in the business purchase account, because now this one will become 156. It will change this figure that we got initially. Remember the one we were computing there? This one will change by 100, a difference of 100. So 1438 to 100, because those figures are now the ones you are seeing here, which now in this case eventually become the ordinary share capital that these guys ended up having to convert. This is the money they were supposed to be paid, but now they converted them into equity in the newly formed companies. So then they got other shares after the company was formed. It gives the total equity at the end of the year. So hope you've been able to see. You've now seen, yes. So that is where now in this case the issue was. So we can look at another one. So I want us to look at another one which had an element of leases. It is April, just after December 2023, there's another one. April 2023 question number 4. You can open that one. April 2023 question number 4. April 2023 question number 4. April 2023 question number 4. Open April 2023 question number 4. April 2023 question number 4. April 2023 question number 4. So I can see Faith is asking. So whenever there's a mistake, always the invigilators will be able to alert you. The invigilators will be able to alert you. Will likely be able to alert you. Then of course, now in this case, if they haven't alerted you or it was not discovered when you are doing the exam, then those who are having to mark the exam, they'll have to be more direct. So in this case, maybe they might issue a free mark for that trade payables or something. Or of course, also in this case, they'll be able to consider your business purchase account because it will have an error also. So they'll be able to consider, they can give you there a free mark. They can give you their free mark. You can be able to see it has only affected like 2 major entries in the business purchase account and of course in the balance sheet. So like you can get 2 free marks. You can get 2 free marks. But if it is discovered while you're doing the exam, the invigilators will likely be able to alert you. If it is not discovered, then it means those who are having to mark, they'll be able to give free marks for those particular 2 entries, those 2 entries. So it says, hope you've been able to open the question. April 2023 question number 4. It says Baraka and Faulu were in a partnership sharing profit and loss equally until 30th of September 2021. Until 30th of September 2021. When they decided to convert the partnership into a limited company known as Buffer Limited. The conversion of the books of account was, however, not completed. The following trio balance was extracted from the books of the account as of 30th of September 2022. So there's, of course, now in this case, what we call revenue, the head revenue, production cost, distribution cost, administrative expenses, inventory, interest paid on loan stock, income tax, dividends paid, property, plant, and equipment, accumulated depreciation, there's a suspense account, trade receivables, there's cash and cash equivalents, there's trade payables, there's provision for a legal claim of 240,000, there's a loan stock, there's lease rentals that they were having to pay. We have in this case deferred tax, we have net profit, then you have the current account, then you have drawings, then you have in this case capital account. So these accounts are just mixed up. They are for the partnership, still they are basically for the company. So they didn't actually do complete conversion and opened proper books of accounts in terms of what conversion. So you've been given a number of additional information there. You're given the closing inventory of 132. So that basically will help you to calculate maybe the cost of sales. Then the second note you are told on 1st of October 2021, the company leased some equipment to boost production. The lease was for 5 years. The lease rental payments were 24 million, payable semi-annually. They were actually payable semi-annually in arrears. The fair value of the equipment was 186 million. Depreciation is to be charged on a straight line basis and allocated to cost of sales. The interest rate implicit in the lease is actually 5% per half year. So per half year. So when they basically converted, they basically leased some, in this case, what equipment. So that means in this case, you'll have to get what? The right of use of that equipment. Then we get the non-current liability element of that lease. Then the current liability element of that lease. Like remember what we did in the other question. So we still have to do it here. So we identify those 3. Right of use of the equipment, the non-current liability element of that equipment lease, then the current liability element of that equipment lease. Then the next note, the suspense account represents sales proceeds from some items of plant equipment which had cost 36 million, which were disposed of during the year. So this means basically we'll come up with a disposal account so that we can be able to get either gain or loss on disposal. The income tax amount of 1.2 million included in the TO balance was the estimated tax as at 30th of September 2021. The current year's tax is estimated at 9 million. In addition, a deferred tax liability of 36 million was provided for as at 1st of October 2021. As at 30th of September 2022, the temporary differences were 168. So you have to determine the income tax, the current tax expense, and of course the deferred tax expense that is supposed to be charged in the books of accounts for the current year. So you'll have to come up with a current tax account and a deferred tax account. A legal claim of 60 million was lodged against the company during the year by a customer. The directors estimated that there was a 40% possibility of the claim being successful and had made a provision of 24 million, which was included in the administrative expenses. So there was a possibility of 40%, it having to be to be successful. So that is what we call provision for contingent liabilities. And of course, in this case, assets. So of course, we normally say if there's a possibility of over 70% is when you end up having to make a provision. I think it is 70% or 75%. If there's a possibility of 75%, more than 75%, is when you make a provision. But if it is below that, then you don't make a provision for it. So it means we'll have to eliminate, that one from the administrative expenses. Then property, plant, and equipment, it is as you've actually been provided for there. So it means now in this case, they want you to compute the depreciation of those properties, plant, and actually equipment. No entries were made to record the conversion of the partnership into a limited company. The assets were taken over by the company on 1st of October 2021, the next day, at their book values, except land, which was revalued to 80 million. The company issued to the partners 32 million shares of 10 each in settlement of their outstanding capital account balances. Capital account balances. So basically that means in this case, that will be now the equity, the equity of the newly formed company, company. So their balancing figure in the partner's capital account will now become the equity in the newly formed company. It means you have to come up with a partner's capital account, so that in this case, you can be able to know what was their balance by the end of the year in terms of capital in the business, which they converted into shares in the newly formed company. So that is what in this case they actually mean there. So it was now 32 million shares of shillings 10 each. The worth of that capital they had, it was 32 million shares of 10 shillings each, which will now be the equity for the newly formed company. So they required, you need to come up with a statement of profit or loss for the year, then a statement of financial position for the year. So for the year. So maybe we can be able to start on it. We can start on it. So of course, now in this case, the closing inventory as per note number 1 will help us now when you are trying to calculate the cost of sales. Then of course, it will likely also be the inventory in the statement of financial position. That one is just very direct. It will help you to calculate the cost of sales because you've been told to come up with a statement of profit or loss. Automatically, that means that figure should be able to help you to get the cost of sales. Then also, it will be able to appear as the inventory in the statement of financial position. Then number 2, you are told, now in this case is all about the lease. The lease of what? The lease of, now in this case, what is it? The equipment. The lease of the equipment. So on 1st of October, the company leased some equipment. So lease of equipment, that is as per note number 2. So you can do some workings. So let's start with some workings. So working 1, so lease of equipment. Lease of equipment. We've been able to say on that lease of the equipment, we are looking for 3 things. So the right of use, the non-current liability element of the lease obligation, and of course the current liability element of the lease obligation. So of course this one, will appear as an asset in the statement of financial position. This one will appear as an uncurrent liability. This one will appear as a current liability. On that lease obligation, there'll be the one that will be paying the current year. There'll be another one. It will be for the it will actually be for the subsequent years. And of course, exactly on the first day of the commencement of this business in this particular year, we are having to do what? Come up with the statement of financial position. Remember, in this case, we are doing the accounts as at the end of 30th of September 2022. And they list on the first day of this accounting period. They list on the first day of this what? Accounting period. So it means we'll have to, in this case, do what? Calculate our lease liability. Of course, I've already been able to advise you. Of course, you've actually been given the fair value. So you are told the fair value of the equipment was 186 million. But now I told you, as per the current standard, that is not how in this case you get the fair value of the lease obligation. You need to, in this case, do what we call what? Discounting. You discount the lease payments, the rental payments. You do discounting of the rental payments. So automatically, we have to start by having to get what? The lease obligation. The lease obligation. The lease obligation or the liability. The lease liability. The fair value of the lease liabilities. The fair value of the lease liability. Fair value of the lease liability. So you'll have to, in this case, discount the rental payments. So you take the rental payments, you multiply by the present value interest factor of annuity. Present value interest factor of annuity. And of course, now in this case, in our case here, it is for how many years? It is, the lease was for 5 years. The lease rental payments were 24 million payable semi-annually in arrears. So that means in this case, our N will be how many years? Our N will be, it means our N will be 10. It will likely be 10 because it is semi-annually. It will be 10 because in this case, it is what? It is semi-annually. So 5 multiplied by 2. The periods will likely be 10. So it will likely in this case be 10. You can be able to take 10 years or 10. So like that. So it means in this case, we will take the rental payments they're having to make. It is 24 million. So it will likely be 24,000 multiplied by, we said what you say, 1 minus 1 plus r raised to negative n over r. So that is how you do it. So in this case, we'll say it will likely be 1 minus 1 plus r is what? R is ningapi? 2.5. Sindio? Because per annum, it is 5%. So for the entire year of 12 months, it is 5%. If it is semi-annually, you divide by 2. So your teacher for FM will tell you divide by 2. If it is quarterly, you divide by 4. So in this case, this one is 0.025. So like that. So raised to negative 10 over, in this case, 0.025. So what are you having to get as the lease liability? What are you having to get as the lease liability? It should be 5%. It should be 5%. Really? It should be 5%. Or it's 5% per half year. Yes, you people are correct. You people are correct. It's 5% per half year. So thank you very much for having been able to spot that. So you can just be able to correct. You can just be able to correct. So it will be 0.05. 0.05. It is 5%. So 0.05 raised to negative 10 over, in this case, 0.05. So of course, that is what you've actually been told. 5% per half year, not per year, but it's 5% per half year. So now you can be able to tell me, what are you getting as the lease liability? You're getting what? You can now do the computation. So this is the correct one, 0.05, because it is per half year. You're getting what as the lease liability there? You're getting 185,321. 185,300. It is almost the same figure you are given there. 185, 321. 185, 321.63. So the others, are you getting that? The others, are you having to get that? So you need to confirm whether you're getting that. Yes, you're saying yes. So that is basically how you end up having to get the fair value. So this is what the current standard calls for. This is what the current standard actually end up having to do what to call for. So that's how you actually end up having to do what compute. So maybe what you can be able to do, since I can be able to see the figure is almost the same, so but maybe we can be able to use this one. So we can in this case comfortably come up with, in this case, what our amortization schedule. So we can come up with our amortization schedule. Remember, this one is actually what in arrears. It is in arrears. Exactly in arrears. Is in arrears. Remember, I told you it is actually in advance. There's a difference here with this period. Probably it will come to 9 periods. It will be 9 periods. But if it is in arrears, they are paying at the end of the year. So you take the entire periods because there was no any amount that was paid initially. So take note when you're talking about advance and of course arrears. So with advance, these periods, they change by 1, they reduce by 1 because there's an amount they pay on the commencement. You don't discount it to the present. It is already in the present. You don't have to discount it. You discount the other 9, which are paid subsequently in the other periods. So that is what you need to be able to take note as the difference. Because it was in arrears, we took all the periods like that. So now in this case, we can come up with an amortization schedule. So we'll have in this case, balance. We can have the period, then of course, balance brought down, balance brought down, balance brought down. Then in this case, if they're having to pay in arrears, if they're paying in arrears, it means it is at the end of the period. After already we've actually been able to accumulate interest on it. So interest will first of all, in this case, have interest there, which is actually in this case at 5%. We'll have interest there, which is actually at 5%. At 5%. Then in this case, after that, we can have now the payment having to be made at the end of the period. Of this payment, we have to identify what is the principal amount. What is the principal amount? Then, of course, what is the balance that is carried down at the end of the year after they have actually already been able to make the payment. So remember, we have in this case the year 2020, this one that is actually ending 2022 up to end of 2022. So maybe you can just be able to say year one. There are 2 periods. For year 1, there are 2 periods, period 1 and of course period 2. Then of course you have year 2. Because in this case, we are only having to look at at the end of the year 2022. Then we want to do an amortization schedule for all the 5 years. We're just interested in 2 years. Because when we be identifying the non-current liability element and the current liability element, you remember what we said? You look at the second year. You look at the second year in terms of what was the payment that was actually done and what was actually in this case, for example, the principal amount maybe in the second year. So we'll just basically do for 2 periods and not for all the 5 years. Like there's that other question we did. You remember that one? We did where I told you we'll do only for 2 years because we'll end there because you are dealing with the financial statements for the current year. But maybe in this case, if you are told the lease started maybe some years back, is when now you need to come up to the current period under which now in this case, we're having to do the accounting. But now it is as the start of the accounting period you're having to deal with. We'll just look for the amortization for just 2 years. We don't do for all the 5 years or the 10 periods. So in this case, we'll have the year 1, then year 2, we have period 1, and of course, period 2. And of course, we'll likely be good. We'll likely be good. We don't have to do for all of them. Don't have to do for all of them. So of course, now in this case, our lease liability in this case is actually 185,321. 185,321. So you can be able to calculate interest on it. So 5% of this. So 5% of that, 5% of that, what do you get? 5% of that, what do you get? 5% of that, what do you get? You can do 5%. You get what? 5% of 185,321. 185, you get 92. I can see 96, 22, 92, 66, which is which? 92, 66, eh? And of course, you round off. If you get a decimal, just round off. Don't give me decimals. Just round off. 92, 66. So then, of course, they make payments. They're having to say they make payments is just constant. So 24, 24. They make constant payments of 24. Yes, 24. They make constant payments of 24. 24. Remember, if it was in advance, this initial payment wouldn't have been there. And of course, now in this case, the amortization schedule would have actually been a bit different. But this initial one wouldn't have been there. It would have actually been accumulated on the right of use of the asset. It would have actually been accumulated on the right of use of the asset. I can be able to see already someone is already asking the right of use of the asset. You'll be able to get it like, it will just be this one. This will be the right of use of the asset. Then, of course, remember, you have actually been told it is having to be depreciated. It is having to be, it will have a useful life of 5 years. The fair value of the equipment was this. The depreciation is to be charged on a straight line basis and allocated to cost of sales. The interest rate implicit in the lease is 5 years. The lease was for 5 years. The lease in this case was for 5 years. The lease was actually for leased some equipment to boost production. The lease was in this case for how many years? 5 years. So what will happen there? You'll actually basically take that lease period to be the lifetime of, in this case, what? That particular equipment, for the lifetime of that particular equipment. And therefore, you'll be able to depreciate it at what? 185,321 over 5. So this will be the right of use of the asset. But now you'll have to get the depreciation of these assets by dividing by what? By 5 to be able to get for each and every year. So we can be able to finish up, first of all, in this case, the amortization schedule. So the principal amount in this case, that was actually in this case settled. Of this, the principal amount that was actually settled. Of these 24,000 they paid, you need to find out, included in it, what was the principal amount. Because in this case, on this 24, they were paying interest plus this principal amount. So I want you to give me the principal amount they were having to settle when they paid this 24. You get the difference there. You get 24,000 minus 92.66. So that you get, in this amount they were having to pay, what was the principal they were settling? Principal amount is this one. You know, when you pay a loan, you normally pay the principal amount plus the interest that has accrued at that particular point in time. So you get what? You get 14,734. So 14,734. And therefore, the balance carried down for the principal amount is how much? You get now this one minus this one minus this, so that you know out of this how much they have actually already been able to settle. So 185,321 minus 14,734. Minus 14,734, you get 170,587. So 170,587. So 170,587, you continue with the cycle, 5% of it. 170,587, 5% of it. 175,87, 5% of it. 85,29, you get 85,29. Then they paid 24 million. Of these 24 million they were paying, what was the principal amount they were settling? You get this minus this. So because in this 24 they were paying interest plus a portion of this. So you get the difference. What do you get? The principal they were settling. The principal amount they were settling. 15,471. So 15,471. 15,471. Then the balance carried down, you take this minus this. Of the principal amount, how much is still remaining to be settled? 155, 116. So 155, 116. It comes here. 155, 155, 116. The cycle continues. Interest at 5%. Interest at 5%. 77.56. So 77.56. Then what was the principal amount having to be settled when they paid this? In this 24, they paid this interest and a portion of this. If you want to know a portion of this which they were paying, so you put it there. The principal, 16,244, 16,244, 16,244. Then what is the balance carried down of this principal amount? What is the balance carried down of this principal amount? What is the balance carried down of this principal amount? 138,872. 138,872. 138,872. So then we bring it here, 138,872. The cycle continues, 5% of it. 138,572. 5% of it, you get 69.44. 69.44. Principal amount. The principal amount. What is the principal amount? Principal amount 17,056. 17,056. 17,056. 17,056. Then the balance carried down. The balance carried down. The balance carried down after you minus 121,816. So 121,816. 121,816. So with that, then in this case, we can be able to identify. We can actually end up having to identify in this case what? The non-current liability, and of course now in this case what? The current liability. Of course, the current liability. So if exactly in this case in arrears, we said you look at the second year. So in this case, if in this case you're having the lease exactly in arrears, you actually look at what? The second year. The second year. So for the non-current liability in this case, we'll actually pick the balance carried down in the second year. Balance carried down in the second year. Then of course now in this case for the current liability, we'll actually pick the principal amount in the second year. 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 So of course now in this case, the balance carried down in the second year is automatically this one. It is this one. It is this particular figure here. Then of course now in this case, the principal amount that was actually having to be paid in the second year, you'll be able to add these two because they were paid. So you'll add those two. So it'll actually be 16,244 plus 17,056. So those are the principal amount that they actually settled in the second year. So they basically now in this case become what? The current liability. They actually become the current liability in this particular first year. Then of course the non-current liability, you pick the balance carried down at the end of what? The second year. So you need to add these two. So 16,244 plus 17,056. What do you get? You get 33 what? 33,300. Is it 33,300? Yeah, 33,300. So of course, now in this case, already you would have already been able to come up with your current liability that will go to the statement of financial position, which is this one. Then of course, the non-current liability, which in this case will likely be this one, will likely be this amount. Then of course, our friend was actually talking about the right of use of the asset. So it will be this one. Then you can be able to consider whether there were any initial cost to facilitate the use of this equipment, but it is not there. So it means in this case, the right of use of this asset, right of use of the asset will likely in this case be 185,321. Then you'll have to consider depreciation on these assets. You'll have to consider depreciation on these assets because you've been told on 1st of October, the company leased some equipment to boost production. The lease was for 5 years. The lease rental payments were 24 million, payable semi-annually in arrears. Payable semi-annually in arrears. The fair value of the equipment was 186 million. It is to be, depreciation is to be charged on a straight line basis and allocated to cost of sales. The interest rate implicit in the lease is at 5% per half year. So of course, you haven't actually been told the lifetime of this equipment. If you haven't been told, you take the lease period as the lifetime of this equipment. So therefore, in this case, it means the depreciation in this case will likely be 185,321. We divide by 5. What do you get? 185,321 divided by 5. When you divide by 5, Another class is waiting. So another class is waiting. So 37,064. So 37,064. 37,064. So like that. So that will be the depreciation. So when you'll be basically be taking this one to the statement of financial position, you have to less this depreciation. Then this one, you're having to be told it will go to the cost of sales. It will go to the cost of sales. So we'll be able to pick up from there tomorrow. Actually, just wanted you to really get this particular concept of the lease. Then after that, tomorrow we'll handle the entire question with the other workings. So now this one is now a lease in arrears. So take note of the difference. Lease in arrears, then in this case, so lease in advance. Lease in advance. So sawa. Let's end there. So we'll wind up with the other workings. Then we close on the question tomorrow. Any concern you might be having? Because I'm told there's another class that is to take up this link. Any concern you might be having, you can be able to ask there. So you can be able to practice the question. You try maybe by tomorrow whether you can be able to handle the other workings. Then when I come in, we just be able to go through. And of course, you'll be able to grasp. We'll be able to grasp. We'll be able to grasp. We'll be able to grasp. If there's no any other concern, then let's end there. I'm wishing all of you a good night. I'm wishing all of you a good night.